Hi, welcome to your special market update. We do this from time to time as a special bonus for members of the candlecharts.com family. We're going to be looking at the Dow now, and I didn't realize that rhymed, Dow now. We're going to be looking at the Dow Jones. And last time we looked at the S&P, and actually when I do most of my analysis, I look at the S&P as a broader based market, but I figured I'd discuss the Dow because that's the index they talk about a lot in the news, so may as well look at it from a technical perspective. Now, the main thing was it broke above a resistance area last week, and by the way, I'm making this recording Monday night, Halloween, and so it broke above the resistance area. Now, this is a nice example of the importance of looking at candlesticks in context, and you'll see what I'm talking about in a second. You know, one of the things we really focus on in our education is not only letting you make sure you understand the correct candlestick signal, in other words, what it looks like, but more importantly, what to do with it. And it's very easy to find definitions of the candlestick pattern, but it's only through true, correct education where you learn what to do with the candlestick signal. And the reason I mention that is because here we had a bearish engulfing pattern. That's when a black real body wraps around a white real body. And some of your charting packages, instead of black, might be red, and instead of white might be green. This is a bearish engulfing pattern. But looking at what we call candles in context, although it's a bearish engulfing pattern, this old resistance shown in the solid blue lines becomes potential support. So although we had a bearish signal, if you did not have the correct knowledge about change, what I call change of polarity, old resistance becoming support, one might think about selling on the bearish engulfing pattern, but by having the correct knowledge, you would know, hey, although it's a bearish engulfing pattern, the market is at support. That is not a good selling opportunity. So indeed, as did turn out to be the case, this old resistance became support. The market had a very nice sharp rally. The small real body here, called the spinning top, is a little hint that the market was losing upside momentum. And then on Monday, a long black real body, another bearish engulfing pattern. And actually, some of you may recognize this as an evening star pattern. Now, by the way, before I do more of the analysis, let me give you a heads up for those who are new to candlesticks and you want to get some basic definitions about like what a bearish engulfing pattern is or what an evening star is, and the evening star is highlighted in the red box. Go to the website, my website, candlecharts.com, and you'll see near the top that I just highlighted with the arrow, we have a free candlestick charting glossary. This is a very basic glossary, but it does give a quick overview of the basic candlestick signals. So let me go back to what we're looking at here. And by the way, this link down here that I'm showing you, candlecharts.com/free education, this is the link that you probably went to get this free education. But if you know people who don't have access to this free education and would like to get our market updates and our educational videos called highlights, feel free to send them this special link and they could register also. And we, as you know, keep all email and contact information confidential. But anyway, getting back to the evening star. So although there's a bearish signal here, as long as this support level holds in the Dow, and by the way, this is just the index, so instead of 118, it would be 11,800. So you know that's just the y-axis. So this would be 11,600, 11,800, 12,000, and so forth. So anyway, the 11,600 down from 11,700 to 11,600 should be a good support area. Under that, I think we've done some damage, but for now, the market broke out of a lateral trading range. The old resistance became support. Just to give you a heads up, though, on the weekly chart, let me just go past, this is the slide I showed you before. Let me show you the weekly chart. What I like about the weekly action, I'll go through what these red and blue lines are. The red line is a prior support area. Once again, this is the weekly on the Dow. And prior support tested a few times. My concern was it could have become potential resistance around 11,900. And the market broke above that very nicely, coming back a bit. But once again, this correction to me is not a big deal. Look at the rally that the Dow has had on the weekly chart. So to have some sort of correction is not unusual. Now, just as a heads up, speaking of heads up, this is a head and shoulders pattern. Left shoulder, head, right shoulder. And the blue line, and I should have made this a little more exact, connecting the lows here, but the blue line is a head and shoulders neckline. And what happens is sometimes the neckline of the head and shoulders becomes resistance. And the Dow did stall at that level. To give you a heads up, though, I don't have it here. The S&P did get above the head and shoulders neckline, and that to me is a positive, but the Dow has not. But to me, the more important aspect is not so much the head and shoulders neckline, and that's probably part of the reason we're pulling back from here in the Dow. Head and shoulders is a very popular Western signal. The more important aspect is we did decisively close above this red line. So I'm positive, with the caveat, once again, that the market has to hold above the prior resistance area, and I'll go back here, above 11,600 based on a close. And for those who trade Forex, very interesting in the dollar yen. Last time we looked at the euro US, we're looking at the dollar. When we did the market update, we're looking at the dollar yen now. And for those of you who are members, we have a member site called mycandlecharts.com. That's mycandlecharts.com. And on that member site, we do daily analysis of the major Forex markets and the S&P and gold and so forth. And the reason I mention that is because one of the things we do with that paid member site, and it's as I just mentioned, a paid member site. So it's addition. You can find out information about it from mycandlecharts.com. You'll see information about mycandlecharts.com member site. But one of the things we do there is give trade suggestions. And the reason I mention that is because when we were looking at the yen within the My Candle Charts website, when we did the forum and the daily market updates, we were talking about the yen, the dollar versus the yen was a potential buying opportunity because of the long lower shadows as the market got near 75.50. Now, even if you don't trade the Forex markets, keep in mind all the analysis we do here and in mycandlecharts.com and anywhere in our education for that matter. It doesn't matter if it's Forex or not Forex. Everything we discuss is true in all markets and all time frames. But getting back to this, we were talking about every time it got near 75.50, look at this, long lower shadow, long lower shadow, long lower shadow, long lower shadow. And what that's visually showing us is the market is rejecting lower levels time after time after time. And this just was a relatively low risk trade from the long side because all you had to do is risk under the 75.50 level, and the upside target would be the top end of the trading range here around 77.50, 77.75 in that area. You know, no way to predict the market's going to get there in one day, but just to give an example of how to use long lower shadows, you can see the market's rejecting lower levels. So it's not only real bodies that we look at, but it's long lower shadows, and some of you may recognize this as a hammer. Not sure if it's a perfect hammer because the lower shadow should be twice the height of the real body. Anyway, now that the market has broken, the dollar vis-a-vis the yen has broken above this resistance area. And by the way, the reason the market stalled around 79.50, look at the highs here, not too far from that 79.50 area that we had in July. But anyway, getting back to this resistance might become a support area right around the 77.60 area. It's actually from, I'd actually make it a little bit lower. I'd probably put a horizontal line over here also down to 77.40. So anywhere from 77.40 maybe to 77.70 should be a resistance area, a support area. Old resistance becomes support. And if it gets under that, the risk is that then down to the bottom end of the trading range. So thanks so much for joining me. Be sure to check all your emails because we're going to be doing these on a very frequent basis, as well as our educational videos called highlights.